Hello, and welcome to Excel Highway. In today's video, I want to share with you how you can create a loan comparison calculator in Google Sheets for free. Using this calculator, you can check different options of loans that you get from banks or other sources of loans. You can play with the interest rate, the loan term, etc., and just see what the implications are for your cost. So if that's interesting for you, stick around and I'm going to walk you through all the steps to build this. All right, so we got this Google Sheet. Hopefully you know how to create the Google Sheet. All right, first off, we start with the loan amount and we put here loan amount at the header and the number. The start date, just put a date, and I changed the format just to show me, where is it? September 2028. Okay, so just to see the month and year. And by doing so, if you double click, it just allows you to select a date. Doesn't really matter. Um, in this model, we're looking at a month-year basis, so it doesn't matter the exact date. Then we have loan option, loan provider, interest rate, yearly interest rate, just to be clear, the loan term in years, and fees for taking the loan. So I have here three options for loans, two different banks, just to show you that, of course, you can have the same bank give you two different options, the yearly interest rate and the number of years. And fees, so when you take sometimes when you take a loan, you have to pay some fees. Then we have some formulas, so monthly payment. We're going to use the built-in function called PMT. PMT is going to return the monthly payment. So using PMT, I want to return a monthly payment. So I'm going to take the yearly interest rate, which is column C, C5 divided by 12. That's going to give me a payment interest rate for 1 month. The term is the number of years times 12 because it's all in the monthly bucket. And A2, that's the present value. That's that's the loan itself. That's what we start. You see, you have other options like future value and end of beginning. So, but if you just use those three arguments with the minus sign before, just to get a plus sign, so you're going to get a different value. And of course, use the dollar sign for A2 because it's static on the loan amount. That gives me the monthly payment, the total cost. That's going to be the monthly payment times the term in years times 12. So 12 payments per year times the number of years times the monthly payments plus the fees gives me the total cost. And if I want the net cost, basically the net, let's say uh, this is what the loan costs me. That's going to be the total cost minus whatever was loaned. So you get 50,000 and you return 60 and a half. So it's 10.5 is your actual net cost. So, and that's much more understandable than someone tells you just the interest rate and percentages and you don't really understand what that means. So, um, and you can play, of course, with the numbers. If I changed it to 12 or 20 years, the more time the loan is, the more the net cost will be, of course, but the monthly payment reduces. So that's the trade-off. The longer the loan, the bigger the total cost, but the smaller the monthly payment. And here you can see three different options with three different interest rates and long and the terms, and you can see what the cost is. So that's how you calculate what we have here. Now we have an option to select one of the loan options. So just using a drop down, very simple, go to data, um, data validation, and you just select the range, drop down from range, select that range that you want, and that's it. So when I change it, it will change everything. So the interest rate, that's just a simple VLOOKUP of the loan option and going 3 steps. So that's the monthly interest rate. Then I have a table here with the payment plan. So it starts with 1 and then just plus 1. That's basically the payment for each month. Then I'm going to use eDate for that starting date, whatever I have here, -1. So that's going to be the first payment. And moving forward, eDate will show you the future date for how many months you want out. Okay, so starting date and number of months. So that is the projected months. Then I have the payment. This is going to be static, so that's the monthly payment. So I'm going to use VLOOKUP for that option. I'm going to return 494 every month. And I want to see out of that payment how much is the interest and how much is the principal. So the interest, that is going to be the interest rate divided by 12 times the loan amount, and the principal is the difference between them. Remaining balance is going to be the starting loan minus the principal, and that's going to be rounded by 0. And the first one references the loan amount, but other rows will reference the row above them. And just drag the formula until you see that you see 0 lines. And of course, if you select a shorter period, then it will be completed earlier. That's it. This can help you create and understand how much are you really going to pay for your loans and create a comparison without any magic numbers behind, so you really understand what's happening. Hope you enjoyed this content. If you did, please hit that like, subscribe, and I'll see you next time.